You've probably heard the buzzwords ESG investing, socially responsible investing, impact investing. They're all ways to do good with your money. But what do they actually mean? The truth is, sustainable investing isn't one thing, it's a whole spectrum. Sam Adams is an asset manager specialising in evidence-based sustainable investing and the co-author of a book on the subject.
Sustainable investing is the overall term that encompasses all the different forms. And within that, there's thousands of ways to invest for sustainability, but there's probably three main categories: ESG, or environmental, social, and governance, social responsible, or SRI, and impact investing.
So let's look at those three different types of sustainable investing in turn. The term impact investing was coined in 2007 at a meeting in Italy of investors and entrepreneurs convened by the Rockefeller Foundation.
Impact investing, I like to think of as a for-profit version of philanthropy. Let's say you find a community that doesn't have a lot of food security, there's a lot of starving going on, and you want to help. Well, you can donate money as a philanthropist and continue to donate and send food in there. Or you could invest in some local farms, help them buy more livestock, buy more acreage, invest in an irrigation system, and they could create more food, sell it to the local community, create profits, and continue their work and feed more and more people, using the power of capital markets to do that.
The phrase socially responsible investing took hold in the late 1960s and early 1970s amid a wave of social activism. What does it mean?
Social responsible investing is an investor who wants to invest more traditionally in public stock markets and public bond markets, but they have strongly held religious or ethical beliefs that keep them from investing in certain things. Say, I don't want to invest in alcohol or tobacco or gambling or pornography, or I'm Catholic and I want to invest according to my values there, or I'm Islamic. And so this is I want to invest for total return like a normal stock market investor, but I can't own these things, so I exclude them from my portfolio.
The third category of sustainable investing Sam Adams referred to is ESG investing. It's the newest type and also by far the biggest. ESG fund managers don't ask investors what's important to them. Instead, they look at companies and ask what environmental and social issues are going to affect their future profits.
Are there any risks in the amount of natural resources you consume or the pollution that you might create as you scale up? Or how are you treating your people? Is there strife in your labor? Or are they happy and contented and productive workers? How is your supply chain? This isn't so much values driven as it's trying to figure out where the risk is that's not reported in the standard company reports. And that type of investing, ESG investing, has been taken up largely by the big institutional investors because they think it's a better way to get a more of a robust grip on the risks that companies are facing.
So, sustainable investing isn't one size fits all. Each approach is different and it depends on what matters most to you. If you want your money to make a difference, it's well worth talking to a financial advisor who really understands this space.